For more in the markets, let's get to our next guest, Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. You've come on and you always have some things that make me scratch my head or that I haven't thought. And one of the things you said not too long ago was that the labor market may have already bottomed, and that any economic slowdown you saw as kind of a rolling sector, one to the next slowdown, and that could be in the past too.
That's right. So, I mean, our call for quite a while has been we've been in a sort of rolling recession that the private economy has been, distorted from post-COVID with every sector kind of going through their own individual recession. So instead of having the one collapse that you typically get, it's been this sort of masked labor cycle. And what we noticed in April, we can go back and look at the data now, is that the rate of change on both payrolls and layoffs peaked or bottomed, depending on which one you're looking at, in April, right when the market bottomed. So, and this narrative that we've had for a while now is becoming a bit more popular. We like that other people are kind of adopting it to some degree because they're looking for a rationale or reason for why the market's done when it's done. And that is very important for next year because, A, it means the Fed has more room to cut than probably people think, okay, or they can do things with the balance sheet. And secondly, you're going to get a rotation now into the parts of the market that have not performed that well. That's our call for 2026.
Why would the labor market not being weak give the Fed more opportunity?
Well, because they're going to realize that the data itself is very lagged. I'm not blaming the Fed. This is tricky. I mean, it's hard. In real time, the data has not been weak enough to justify cutting more. But when they actually look at the revisions now, and that's what we do, we look at the revisions, it's very clear that we had a significant labor cycle.
We already came out of it.
And we've come out of it, which is very good. And by the way, the best confirmation of this is that the earnings growth now for the median company in the S&P is actually growing again, close to 10%. That's the best growth we've seen in 4 years. So there's evidence.
But you are counting on the labor data still being lagged for why the Fed will cut rates, that they're not going to pay attention to the things you're watching right now.
That's right. Well, I think what they'll notice is that if you want a recovery in the private economy, which we all do, right? We don't want to just have this bifurcated economy. They'll realize that we do need rate cuts for the financial leverage part of the economy, whether it's housing, consumer goods, the lower end consumer. We need that. And so the risk in this strategy, of course, for the Fed to think about is, do we have an asset bubble then, right? Because if they cut into that good earnings cycle, do we get kind of an inflated stock market? Our view is yes.
Asset inflation, and people are still worried about big inflation. The overall term inflation, people are still, we're 3%.
Right.
The lagging numbers there, it would indicate what in your view, that it's not a problem or it is a?
Well, I mean, it's sort of a feature. Okay, quite frankly. Like, in other words, and we said this last time. If we don't get inflation next year reaccelerating, then our call is going to be wrong. In other words, accelerating inflation is good for company earnings for the companies that have been lagging. But it's bad if the Fed is raising rates for the stock market. This time around, right, we have a Fed that's not going to be raising rates. I don't know how much they're going to cut next year, but it's unlikely they're raising rates, and they're probably going to add liquidity to the balance sheet at a time when accelerating inflation is driving better earnings growth. That's a very good setup for equities typically.
And you know what else? Hassett was on yesterday, and he said the way administration handles the affordability issue is by wage gains. I think they've given prices that, energy prices can come down, food prices can come down, but in general, inflation doesn't come down unless you got serious overall problems in the economy. So how do you deal with the affordability? Wage growth has to be faster than the inflation.
And productivity.
And productivity.
That's right.
And you think that's possible?
Well, yeah, I mean, that's what the policy change is trying to do, right? Is that
which policy? The BBB?
All of the fiscal policy. Let's think about this. So they're trying to reduce consumption, okay, increase investment through the Big Beautiful Bill and through tariffs. That reconfiguration of how the economy grows should lead to better productivity. The big one that there's debate on, which I don't think is really that debatable, is immigration. Right, so this, legal immigration, unfettered immigration has really suppressed real wage growth, to your point, for the middle income, for the lower income workers. And then if you think about AI suppressing wage growth, perhaps at the upper end, that's a nice rebalancing potentially on the real wage. Look, this is not it's not going to guarantee it's going to work, but I like that strategy as a way to rebalance the K economy.
I said BBB. That's Bed Bath & Beyond, our favorite. I meant BBB. Only
it was
three B's.
It was our favorite.
I know it's
Saturday. It's a rainy Saturday.
You know what they say? We'll always have.
We'll always have Bed.
We'll always have Bed Bath. So that makes you think about the S&P next year with what type of numbers?
17% earnings growth.
Oh my God.
Think about that. 17% earnings growth.
So the PE stays the same.
The PE stays the same. It doesn't have to expand to get another 10 or 15%
what is
earnings
that?
growth.
What's 6,900 times?
7,800. Because you're going to price it off of 2027. Okay. So 2027 will grow another 10 to 12%, assuming we don't have a slowdown. The risk in this strategy, by the way, to be clear, is that inflation does come back to a point where the Fed has to react. Like, I don't care who the Fed chair is, okay? People can make their stories about this one's more dovish.
Yeah, but inflation's here. Inflation's here. You cannot ignore.
They will respond. The question is, at what point do they feel like they have to then raise rates into that? And that will kill the bull market, just like it did in 2022.